These are not luxury problems. These are not discretionary emergencies. These are the most basic costs of remaining housed, staying healthy, and preserving some kind of stability. And that is the point. These are not people making reckless financial choices. These are people whose cost of basic survival in the current economy has exceeded what their wages can support. The executive director of the National Institute on Retirement Security, Dan Doonan, put it plainly, outside of high earners, Americans are choosing survival over savings and hoping to catch up later. And really, that may be the most honest summary of the retirement crisis in America. This is not primarily a story about people failing to understand compound interest. It is not mainly a story about poor discipline. It is about the structure of the American economy itself. Housing, healthcare, education, and basic needs have risen faster than wages for the majority of working Americans over 3 decades. The result is that workers have almost no margin left to save consistently, and more of them are being forced to raid the little retirement savings they do have as a last resort emergency fund. Look at the numbers. The national median rent crossed $2,100 per month in early 2026, according to Zillow data, while mortgage rates remained above 6.5%. For a worker earning the median wage of approximately $60,000 per year, housing alone can consume more than 40% of gross income before taxes. The Kaiser Family Foundation found that 41% of American adults carry some form of medical debt, with the median amount owed at approximately $2,000. A single emergency room visit can cost $2,000 to $5,000 after insurance. A chronic condition can require ongoing spending that erodes savings month after month, year after year. So no, the hardship withdrawals are not evidence of poor planning. They are evidence of an economy where the cost of survival is now pressing against the limits of what wages can sustain for a large and growing part of the working population. And here is where it connects directly to Wall Street's dependency on your 401k. The financial industry needs those $49.1 trillion to remain invested in the market because that asset base is the foundation of its entire business model. Asset management companies, fund administrators, brokerage firms, record keepers, advisors, consultants, all of them make money primarily from assets under management. They charge fees, often small fees, as a percentage of the total money they oversee. When the total asset base rises, their revenue rises. When the total asset base falls, their revenue falls. Their interest is mathematical. It is the same logic that once drove housing appraisers in a rising real estate market. Asset values need to rise, or at minimum, remain elevated, because the business model depends on the value of the underlying assets. When people panic in a downturn and pull money out of their 401k plans, 2 things happen at once, and both are terrible for the industry. First, assets under management shrink, which reduces fee income. Second, the act of selling by millions of small investors can intensify the decline in asset prices, which then shrinks assets under management even more, which then reduces fee income even more. That cascading withdrawal scenario is the nightmare. And this is why every major piece of retirement advice in America, from every major financial institution, ends up repeating some version of the same message. Stay the course. Do not try to time the market. Long-term investors should not react to short-term volatility. The market always comes back. Time in the market beats timing the market. Now, to be fair, these statements are often genuinely true. The market has historically recovered from every major crash in the modern era. Long-term investors who stayed invested through the 2008 financial crisis and the 2020 pandemic crash did eventually recover and, in many cases, prosper. So the advice to stay invested is not necessarily wrong, but it is also not neutral. The advice to stay invested comes from the same institutions that collect fees on the assets that stay invested. So the advice is both accurate and self-serving at the same time. And in a moment like April 2026, when market conditions are unusually stretched, the conflict of interest matters more than usual. Consider the setting. The Buffett indicator is sitting at 232% of GDP. The Shiller CAPE ratio is at levels seen only before the dot-com crash. The Iran war is producing an energy shock. The OECD is forecasting United States inflation at 4.2%. Mohammed El-Arian is warning of stagflation. Janet Yellen is acknowledging that the preconditions for fiscal dominance are strengthening. Jerome Powell is saying the debt path will not end well. That is not a generic long-term average environment. That is a specific moment with specific risks. And yet the advice coming from institutions whose revenue depends on assets remaining invested is still the same comforting message. Stay the course. And that brings us to the concentration risk inside the $49.1 trillion pile, because this is the mechanism through which Wall Street needs your 401k to help sustain the market during the next downturn. The S&P 500 currently has its 5 largest constituents: Apple, Nvidia, Microsoft, Amazon, and Meta, accounting for a historically unusual share of its total weight. When a small number of companies dominate the index this heavily, and when most retirement money is allocated into funds that track that index, then the retirement savings of the American population become tightly linked to the performance of those same companies. And here is where the structure becomes self-reinforcing. The $500 billion to $1 trillion in retirement, inflows that collectively enter the market each year do not spread evenly. They flow into index funds that must buy the largest companies in proportion to their market capitalization. That means Apple gets more automatic buying pressure from retirement contributions than any other company because it is the largest. Nvidia gets the next most, then Microsoft, then Amazon, then Meta. The retirement system itself has become an engine of automatic buying for the biggest technology names in the market. That creates a loop. Retirement contributions buy the largest companies. The buying pressure pushes their share prices higher. Higher prices increase their market capitalization. Larger market capitalization increases their index weight. Larger index weight means they receive more of the next wave of retirement contributions. And so the cycle repeats. When this loop is rising, it looks brilliant. It feels obvious. Anyone who put retirement money into an S&P 500 index fund over the last 15 years has done very well because the giant technology companies at the top of the index performed extraordinarily well. The average 401k balance rose 13% in 2025, the third straight year of double-digit gains because the markets were strong. But when that loop reverses, it becomes the exact mechanism that can amplify losses. If the price of Nvidia or Apple or Microsoft falls hard, the index falls with them. And once the index falls, the damage does not stay isolated. It begins to spread through the system itself. The decline triggers automated rebalancing inside target date funds, which sell declining equity holdings and buy bonds to maintain their prescribed allocation. That selling adds to the downward pressure. The deeper decline creates more anxiety among individual investors, some of whom begin taking hardship withdrawals to access cash, which further reduces the asset base. And as that asset base shrinks, Wall Street's fee income shrinks with it. That is why every major financial institution has an incentive to slow outflows using the same retail investment message it has repeated since the 1990s. Stay the course. But really, the most dangerous point in all of this is not just volatility, it is timing. The AARP found in its 2026 survey that 7% of retirees have already returned to the workforce because they cannot afford to stay retired. Not because they want to remain engaged, not because they miss the routine, because the retirement savings they accumulated were not enough to sustain them. And that shortfall was shaped by several forces working together: hardship withdrawals before retirement, insufficient savings rates during working years, and one of the most dangerous forces in retirement finance: sequence of returns risk. That risk is worth understanding with precision, because it is the exact mechanism that makes this entire system so dangerous for people near retirement. Two investors can earn the exact same average return over a 30-year period and still end up with completely different retirement outcomes depending on when the good years and bad years occur. If the bad years happen at the beginning of a 30-year accumulation period, the investor still has time to recover through future contributions and future growth. But if the bad years arrive at the beginning of a 30-year withdrawal period, the investor is forced to sell assets at depressed prices to fund daily living expenses. That permanently shrinks the base that any later recovery would have grown from. The mathematics are brutal because they are not symmetric. A 20% loss in year one of retirement is far more damaging than a 20% gain, even if the average return across 2 years ends up being 0%. Why? Because the sequence matters when money is being withdrawn rather than added. Once you start retirement, bad early returns do not just hurt, they compound the damage. And that is exactly why the people now approaching retirement age are standing in one of the most fragile positions in the system. For millions of Americans nearing retirement or newly retired, the S&P 500 sits near record highs built on a combination of artificial intelligence enthusiasm, taco trade optimism, and ceasefire relief rallies. But beneath those highs lies the real danger. If the first years of retirement coincide with below average or negative returns, the income those savings can provide falls sharply, even if the long-run average return eventually looks normal. For workers between 55 and 64 years old, with a median retirement balance of $30,000, this is not some abstract portfolio theory. This is a cliff. They are trying to retire on $30,000 plus Social Security. If poor returns hit early, it does not merely trim their retirement income. It wipes out what little margin they had. And this is where the so-called retirement heist becomes visible in its clearest form. It is not theft in the criminal sense, not a straightforward crime. It is something more subtle, more systemic, and in some ways more powerful. The financial system has created a structure in which the retirement savings of ordinary Americans are placed into markets priced for the optimism and liquidity conditions of a very specific moment. Those savings are then managed for fees that steadily transfer part of the gains from investors to financial institutions over time. At the same time, every major institution inside that system has a built-in incentive to keep those assets invested regardless of market conditions, because its revenue depends on assets under management. And the deeper you look, the more obvious the imbalance becomes. The concentration of retirement assets into index funds that must own the biggest companies by market capitalization creates a self-reinforcing dynamic that can push valuations beyond what independent analysis might justify. The workers who most need stability are the ones with the least access to the system, the least understanding of its costs, and the fewest options when market conditions turn against them. That is why the $955 median exists alongside the $49.1 trillion total. The system works extraordinarily well for people at the top of the wealth distribution, for those with large, diversified, well-managed retirement accounts, low fees, and long-time horizons. And it works progressively less well as you move down the ladder toward the millions with no plan access at all, the millions who have access but cannot contribute enough because wages barely cover survival, and the millions who did manage to save something meaningful only to raid it later because there was nowhere else to turn. The 6% hardship withdrawal rate is the clearest measurement of how many people have reached that last stage. 6% of 401k participants took money out at the worst possible time, paid taxes and penalties, and permanently cut into their future retirement security because the alternative was foreclosure, eviction, or unpaid medical bills. And this happened in 2025, a year when the stock market gained 16% and the S&P 500 sat at record highs. A year when the headline story about retirement looked positive, but underneath those record highs, 6% of participants were already living through financial emergencies severe enough to force them into their last pool of liquid capital. Now ask the harder question. What happens when the market is not at record highs? What happens when returns turn negative in the first years of retirement for people who already do not have enough? What happens when the $49.1 trillion total contracts because the market corrects from a Buffett indicator of 232% towards something closer to historical norms? The hardship withdrawal rate will not fall in that scenario. It will rise. The people already using their 401k as an emergency fund will need it even more desperately when economic conditions worsen at the same time as markets decline. And every hardship withdrawal in a falling market locks in losses that no rebound from the bottom can fully undo. So what can actually be done with this understanding? The honest answer demands precision, not slogans, not generic advice, because everyone's situation is different. The right response depends on age, income, debt, time horizon, and tolerance for risk in ways no broad video script can fully capture. But there are 3 conclusions that the specific data from April 2026 supports, and really, they deserve to be faced honestly without the institutional bias that shapes so much financial guidance. The first is that the median retirement reality is genuinely alarming for the majority of Americans, and acknowledging that reality is the beginning of any serious response. The $955 median is not the result of personal laziness or widespread ignorance. It is the outcome of a system that shifted the burden of retirement security from employers and government onto workers without solving the wage problem, the housing problem, the healthcare problem, or any of the other pressures that determine whether saving is even possible. You cannot out-thrift a system where wages have lagged the cost of survival for decades, but within those constraints, certain choices still matter. Maximizing any employer match that is available remains the closest thing to free money in personal finance. And using low-cost index funds instead of higher-cost active funds when both are available still matters enormously over time. The second is that the concentration risk inside the S&P 500 is real. It is not imaginary, and it is worth understanding. Owning a single S&P 500 index fund is not as diversified as it sounds when the top 5 holdings represent such an unusual share of the index. True diversification means owning assets that are not perfectly correlated with one another. Not just owning 500 companies that are all exposed to the same optimistic macro narrative and may all decline together under the same pressure. International equities, small-cap stocks, bonds, and real assets that behave differently under the economic conditions of 2026 are worth understanding in terms of how retirement savings are allocated across them. The third point is the hardest, and maybe the most important. The advice to stay the course is often correct for long-term investors with decades before retirement. But it is not a universal commandment. It does not apply identically regardless of age, balance, time horizon, or circumstances. A 30-year-old with a modest balance and 3 decades of future contributions ahead can often ride through any correction, because time and future savings are powerful advantages. A 62-year-old with a modest balance and sequence of returns risks staring them in the face, is living in a completely different reality. Advice that is correct for one of those people is not automatically correct for the other. And understanding which person you are, based on your own facts rather than somebody else's institutional incentive, may be the most valuable financial exercise available right now, because the $49.1 trillion total is real. The $955 median is also real. The record hardship withdrawal rate of 6% is real too, and it exists in the very same year as record stock market highs. The financial industry needs those $49.1 trillion to remain invested because its fee revenue depends on assets under management. The institutional incentive and the individual investor's optimal strategy are not always the same. And the specific economic environment of April 2026, with warnings from Mohamed El-Erian, Janet Yellen, and Jerome Powell about inflation, debt, and market valuations, with ceasefire fragility in the Middle East still creating energy price uncertainty, with the Buffett indicator at the highest level ever recorded, is not some generic long-term average scenario. It is a specific moment in history with specific risk characteristics. It deserves specific, honest analysis, not just the comforting institutional line that everything is fine and everyone should simply stay the course. The retirement heist is not a crime. It is a system. It was built over 40 years of policy choices, corporate decisions, and financial industry advocacy. It produced a world where the burden of retirement security shifted from institutions to individuals, a world where the cost of staying invested flows partly and continuously to the financial industry through fees and commissions, a world where the concentration of retirement assets into a small number of giant technology companies ties the market's performance directly to the retirement security of millions, and a world where the advice those millions receive about retirement comes mainly from institutions whose revenue depends on those savings remaining invested. Understanding the system is not the same as rejecting it. The market has recovered from every crash in the modern era. Long-term investing in low-cost, diversified funds remains the most evidence-supported approach to building retirement wealth for most people. But the $955 median is not the result of bad stock picking. It is the result of wages that do not support saving, costs that consume every margin, and a retirement structure that works best for those already closest to safety. The question is whether you understand that structure well enough to make decisions that serve your actual interests, rather than the institutional interests embedded all around your retirement savings through advice, product menus, and structural incentives. The $49.1 trillion total is real, so is the $955 median, so is the 6% hardship withdrawal rate in a year of record market highs, and so is the institutional interest in keeping all of that money invested at all times, at all valuations, and in all market conditions. Because that is what generates the fee income that makes the $49 trillion retirement industry one of the most profitable financial systems ever built. Your 401k is not just your retirement account. It is also a revenue stream, a liquidity provider, a structural support for market valuations that the financial system depends on to remain profitable. Understanding that does not require abandoning the system, but it does require engaging with it on terms that protect your retirement security rather than automatically serving the institutions that benefit from your continued participation, no matter what conditions look like. $955 is the median. $49.1 trillion is the total. The distance between those two numbers is the story of who this system was built to serve and why. If you found this analysis useful, leave your thoughts in the comments, hit like, and subscribe for more. Your perspective matters, and if you see something differently, say it. That conversation matters too.